Okay, so this is our value line stock project. My name is Maggie.
My name's Maddie.
So the stock we chose to research is Disney. And just to start with giving a brief overview of the company, Disney is currently doing really well. Their stock prices have been up and they've actually beat its previous all-time high. And also stock prices have continued to rise since the last value line release. Investors and customers have really high growth prospects and bullish perspectives on the Disney stock. In terms of recent developments and potential plans for Disney, they have come into the streaming industry through Disney Plus, which is where they will, a platform that's going to include a good portion of Disney's classics and as well as new releases in terms of movies. They also have plans to expand on current theme parks and build additional ones. They hope that this will help potential revenues and profits after it's been a little bit down since their October period, with June being typically where they achieve their highest revenues. And finally, we do recommend to buy stock in Disney currently. Like I mentioned, there are high growth prospects, and although they had taken a recent hit with the fact that many consumers are choosing to steer away from cable TV, which is where a lot of Disney's entertainment is provided, DTC revenues have risen 15% over the past quarter, and they're showing improvements and plans to steer away from the cable industry and attract to changing consumer preferences. So now I'll pass it off to Maddie to talk about some of our calculations.
Okay, so the first topic we're going to talk about is the price of Disney stock. So the most recent price of Disney stock was $141.25, and this is fairly close to the recent high of Disney stock and the recent low of Disney stock, which you can see on the screen. And this is pretty typical of a large cap stock like Disney. It's well developed, it's been around for a long time, and they are pretty steadily increasing revenue as the years go by. So we're not going to expect large changes and large gaps between the recent high and low and the current price. This is why also we rated Disney a price stability rating of 88, because we think that they're pretty fairly steady, but also when they release new big things like Maggie was talking about Disney Plus, then we can expect some increases in the stock price. So now moving on to talk about dividends, I'm going to pass it off to Maggie.
Yeah, so Disney only pays their dividends in the quarters of March and September. And following recent trends for Disney, these two payments have always been the same. So in order to calculate our September dividend payment, we just took a look at March's, which was 88 cents, and used that. And then we added these two numbers together to calculate our total annual dividend payment of $1.76.
Moving on to talk about some valuation techniques. So talking about the price to earnings ratio a little bit for Disney, we just took the stock price and divided it by the earnings per share for the company, both of which are on the screen, and the price to earnings ratio was $15.85. So this is basically the price that people will pay for a certain amount of earnings, and it relates to whether people would buy the stock or not and if they want to sell or not. So that's why we looked into that a little bit. And the difference between price to earnings ratio and the trailing PE ratio is just the fact that the earnings per share is the earnings per share for the last 12 months. So it's the total earnings per share over that time. So we don't know exactly the specific number that will be released in July, but we estimated that it would be around $8.95. So that's why we have our trailing PE ratio a little bit lower than our regular PE ratio. Moving on to revenue per share, Disney is a large company, so it's no surprise that they are making almost $60 billion in revenue, and also no surprise that they have almost 1.5 billion shares of their stock. As we touched on earlier, there's a lot of different facets of Disney, and they are making revenue in a lot of different ways. So, like I said, it's no surprise that these numbers are so big, and it led to a revenue per share of almost $40, which is good for anyone who owns shares in Disney.
And so finally, to wrap things up, we just wanted to touch on some of the problems that we faced throughout the project. So part 3 is definitely the most challenging aspect of the project for us, just because we're working with a lot of new jargon and a lot of new numbers. that we aren't as familiar with, so it was kind of harder to understand maybe the significance of some of these numbers, and kind of knowing our predictions correct is just kind of the right way to do things. But we think with a lot of research and looking into past finances for Disney and other value line reports, we think we have a solid enough understanding that our predictions are relatively accurate, and we understand what a lot of these numbers actually mean for Disney. And then for part 2, it was relatively straightforward for us. I think we had a better time, just looking at the value line report and pulling and understanding information from there. However, like part 3, there were some terms that we just weren't as familiar with and had to research in order to understand exactly what they meant, such as the insider's decision box. That one we originally had a harder time understanding, but we think that we have a good basis of it, and we're able to come up with a good response for those questions in part 2. Overall, we thought the project was really interesting, and we learned a lot about what really goes into understanding the prospects of a stock and how well they're doing for a company. So I think we understood the relevance of a lot of these numbers and came out with a good project.